Welcome. We're about to do a technical deep dive into Ind AS 2 inventories. We're going to move beyond the high-level summary and really get into the core principles, the measurement mechanics, and, most importantly, the critical judgment areas that can have a material impact on the financials.
So let's start by grounding ourselves in the standard's core objective. At its heart, it really all comes down to one primary issue. What is the right amount of cost to recognize as an asset and carry forward until you can finally recognize the related revenue? This single principle, right here, is the foundation for everything else we're going to cover.
All right, so first things first, we need to define the boundaries. Before we can even think about measuring inventory, we have to be crystal clear on what is, and, just as importantly, what is not, considered inventory under Ind AS 2. This first step is absolutely critical.
Now, as you'd expect, the definition covers the usual suspects: raw materials, work in progress, finished goods. But for experienced practitioners like us, the real nuance isn't in the definition itself. No, the challenge lies in its application, and, more importantly, in understanding the scope exclusions. That's where things get interesting.
And here's where we see that complexity in practice. You have to remember that the core measurement principle of lower of cost, or NRV, doesn't apply across the board. Financial instruments and biological assets, of course, have their own dedicated standards. But you need to pay very close attention to those specific carve-outs for certain agricultural producers and commodity broker traders. You'll notice their inventories are measured differently, at NRV or even fair value less costs to sell. This is a crucial distinction that is very easy to miss.
So, with the scope clearly defined, we can now tackle the first pillar of measurement, determining cost. And as the standard makes very clear, cost is far more than just what's on the purchase invoice. It's a very prescriptive buildup of specific, defined components.
The standard breaks it down for us pretty logically into three buckets. You've got your cost of purchase, your cost of conversion, and then a catch-all for any other costs necessary to bring the inventory to its present location and condition. So, let's dissect each of these.
We'll start with costs of purchase. As laid out in paragraph 11, this goes way beyond just the invoice price. It's a much more comprehensive buildup of every single cost that is directly attributable to acquiring that inventory.
This example, which is pulled straight from the ICAI module, is a perfect illustration of that buildup. Look at how non-refundable taxes and inward freight are capitalized, as they should be, while trade discounts are correctly deducted. The key takeaway here, and this is a common point of error, is that any refundable taxes, like GST, where you're getting an input credit, are explicitly excluded from the cost.
Next up, costs of conversion. Okay, so now we're moving from a simple trading business to a manufacturing environment, and this, as you know, brings a whole new layer of complexity to the table, especially when it comes to allocating those production overheads.
The distinction between fixed and variable overheads is absolutely critical. See, variable overheads are allocated based on the actual use of production facilities, which is pretty straightforward. Fixed overheads, however, must be allocated based on the normal capacity of those facilities. Any unallocated fixed overheads that arise from, say, abnormally low production, well, those have to be expensed in the period they are incurred. This whole concept of normal capacity is a major area of management judgment, and as a result, a huge focus for auditors.
So once we've gone through the meticulous process of calculating cost, we're still not done. Now we have to turn to subsequent measurement and the second half of that core principle, making sure inventory is never carried at an amount higher than what it's expected to realize.
And there it is, the fundamental rule from paragraph 9. This is a direct application of prudence. Cost essentially acts as a ceiling. Inventory cannot be valued at more than what the entity actually expects to get from its sale or use. Anything above that has to be written down, period.
Now, it's absolutely vital that we're precise about what net realizable value, or NRV, actually is. It is not fair value. It's an entity-specific measure. It represents the net cash inflow that a specific company expects to generate from its inventory in the ordinary course of its business.
This right here is such a common point of failure in practice. NRV is an entity-specific value. It reflects the company's own unique expectations and plans. Fair value, on the other hand, is a market-based measurement defined over in Ind AS 113. Confusing these two is a frequent error that gets flagged in regulatory reviews, so this distinction is paramount for both preparers and auditors.
When it comes to cost formulas, paragraph 25 is both clear and quite restrictive. For your interchangeable items, the choice is limited to either FIFO or weighted average. LIFO, as we all know, is explicitly prohibited under Ind AS.
And the guiding principle here is consistency. You have to apply the same formula to all inventories that have a similar nature and use. This prevents companies from cherry-picking methods to manage earnings.
This brings us naturally to the areas that require significant management judgment. These are the hotspots that are almost guaranteed to attract the most scrutiny from auditors and regulators.
As practitioners, we all know applying these standards is never just a mechanical exercise. It's all about applying sound professional judgment. So, within Ind AS 2, where are those high-risk estimation areas that demand our utmost skepticism and focus?
First, as we've already discussed, determining normal capacity is a massive estimate. Remember, the standard defines it as the production you expect on average over several periods. An aggressive, or let's say overly optimistic assessment here can directly lead to overcapitalizing fixed overheads, which in turn causes a material misstatement of both inventory and profit. And second, the entire NRV calculation is, by its very nature, an estimate. It requires management to make forward-looking judgments about future selling prices, about the costs to complete production, and about the costs necessary to make the sale. This process has to systematically factor in things like obsolescence, physical damage, and changing market dynamics. It's a prime area for rigorous audit testing.
And this isn't just a theoretical risk. This is a direct observation from an ICAI study on Ind AS compliance. Companies were found to be incorrectly referencing fair value in their accounting policy disclosures for inventory, instead of net realizable value. That is a clear-cut compliance failure, and it just goes to show you how important precision in both language and application really is.
Okay, finally, let's tie all of this together and see how this detailed technical accounting actually culminates in transparent reporting in the financial statements. Paragraph 36 gives us a very clear, non-negotiable checklist for our disclosures. You have to disclose your accounting policies, including the cost formula. You need to break down the total inventory by classification, and you must disclose the amount expensed as cost of goods sold, any write-downs, and, critically, the details and reasons for any reversals of previous write-downs. These are absolutely mandatory for compliance.
And this really illustrates the end-to-end impact. You see, the inventory balance we calculate under Ind AS 2 isn't just a balance sheet figure. The period-over-period change directly drives a key line item on the face of the Statement of Profit and Loss, just as mandated by Schedule 3 of the Companies Act. It has a direct and often material impact on your reported profit.
So I'll leave you with this final thought. Mastering the compliance side of Ind AS 2 is, of course, the baseline. It's essential. But the real strategic value is unlocked when you use this detailed cost and valuation data proactively. Is it informing your pricing strategy? Is it helping you spot production inefficiencies? Is it guiding better capital allocation? That, right there, is the ultimate test of a truly robust inventory accounting system.